Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer of Financial Enhancement Group. Thank you so much for clicking, giving us a few minutes of your time on this. Market Carver could be an important one. It certainly is an important time given what could be a pivotal Fed meeting. That's certainly going to be the main thing we talk about today, but there's also a couple other items to tidy out. We're going to talk about participation in the market, one of our themes here as of late. And then looking at what the advance in the markets this year might mean towards 2022. So here's a little bit of awkwardness with this Market Carver. So the recording here is actually taking place before the Fed meeting. You're likely watching it afterwards. All right, so that timing here means that we're going to find out the decision on a couple of the items that we're pointing out. Nevertheless, I can kind of point the construct and things that we'll really be looking at, and hopefully we'll have found out in a way to navigate that once you are actually watching this video. So why are we talking about a Fed pivot? Well, first of all, we don't fully know to the extent to which they're going to pivot. And by pivoting, they were extremely dovish, going all the way back to March of 2020. And the uniqueness is the extent to which they have stayed dovish, or in other words, really easy on monetary policy, kept their foot on the gas. We know because they've told us that they're going to let the foot off the gas, just to keep it in simple terms. What we don't know is at what extent they're going to actually pump the brakes. And this Fed meeting presents the opportunity for them to pivot and actually put on the brakes besides just letting off the accelerator. Why is that? One of the things we like to point to is the Taylor rule. The Taylor rule is dropped out of our vocabulary for much of the past decade because we've been in such a unique monetary environment. Historically, the Taylor rule, which is a prescribed set of rules for how the Federal Reserve ought to set interest rate policy, rather than having 12 Fed members sit around the table and decide, which is the case, right? You have a chairman and then 11 others. They come together and they vote, and they say what interest rates would be. Rather than that framework, the Taylor rule presents mechanical, systematic, certainly appeals to the way that we manage money. Give us an exact signal for what the rates ought to be based on the level of employment and inflation. Drop all those variables in, and then you get sped out an actual rule. And you can see over time, the blue line is the actual Fed funds rate or the Fed rate policy, and the white line is what the Taylor rule would indicate. It's not a perfect correlation. The Fed has always subscribed to that, but most of the members at least adhere somewhat to that general framework. There were a few key differences here over the past decade. Go back to the great financial crisis. The Taylor rule actually suggested early in 08 that the Fed get even more aggressive, take interest rates deep into negative territory, and keep it there. That tells you the extent to which it thought that the Fed ought to be easy. And of course, they never got that easy. They did in Europe, but we never embraced negative rates here in the United States. Then we get to a point where the Taylor rule began suggesting interest rates go up quicker than the Fed did, and they never really caught up to that cycle. That big fallout, that big deep gash here in 2020 is, of course, the COVID environment where everything was out of whack. So don't pay too much attention to that. But now we're at a point where that Taylor rule is rebounding, and we get a chance to see a Taylor rule now that's right around. This suggests that the interest rate ought to be well north of 5%, and we're still sitting at 0. I personally don't know what the right answer is, but I can tell you this. There's a lot of people around that table. Of those 12 members, a lot of them subscribe to this policy, and they're going to have some tough questions in terms of keeping interest rates at 0 for too much longer. So this is one of those main things that could change, and we'll find out from this Fed meeting, but this explains why they may very well be pivoting more towards a foot on the brake or higher interest rates sooner than when previously thought. We don't know, but certainly the ground is laid for them to do so. And this is another look at that, another reason why we may see more of a pivot. The bottom panel is the effective funds rate, which was at 0 for a long period of time. We began increasing them into 2018, and then they dropped back down to 0 in the crisis last year. In the past, you can see four vertical lines. What those mark are the periods right before the Fed goes to raise interest rates. What was consistent in each of those is that the Fed's employment, the labor market index, this one is a Kansas City Fed measure. You can see the labor market conditions index crossing above zero and beginning to increase. And we have done that and then some. So from all angles right now, the groundwork is led for higher interest rates. It may just be quicker and more than previously thought. Moving now to technicals in the market, something that we've had our eye on. Even though the S&P 500 continues to advance and see new highs, that is the very top panel. Last week, we actually made a new high and closed the week on one in the S&P 500. However, underneath the hood of those 500 stocks, we again see fewer and fewer and fewer stocks participating in that rally. We got three different charts here. The percentage of those 500 that are above the 20-day moving average, the percent that's above the 50, and percent above the 200. In each case of those, we see declining number of stocks who are above those averages. Keep it simply, we've got what is in many cases a market that is led by the generals, with the soldiers not necessarily following the battle. And that can only go on for so long. Either one of two things need to happen. Either the generals and the index itself, the S&P 500, comes down and really follows the lead of the soldiers, or we see a correction in those individual stocks and they catch back up to what's a healthy market. History tells us to be a little bit more on the cautious side, and that's why we have a lot of our stocks on watch lists and at exit points where we want to have that exit door nearby. Lastly, so we've seen an up market in 2021. What does that tell us about 2022 in terms of a predictive value? Or said another way, to what extent does a winning year or a losing year suggest that you have a repeat or a reversal in the following year? The answer is absolutely nothing. There is no predictive value from the returns in one year into the returns in the following year. The relationship between those two variables is all over the board. For you math majors, the regression analysis there is really close to zero, or literally absolutely no relationship between the two. Something to keep in mind as we have an advance, and some of us have in the back of our minds, hey, what goes up must come down. Not necessarily the case. Please feel free to give us a call. Schedule your complimentary meeting today. If we haven't had the chance to work with you yet, call 1-800-928-4001 or simply scan the QR code. And don't forget, you have chances to catch our radio show. Consider this either live over the airwaves or however you get your podcast. Thanks again for these few minutes. Hope you have a great weekend.